Hi, it's Aoife Devitt, and welcome to today's Markets Happy Hour podcast. It is Friday, December 26th, the day after Christmas. I hope all of our listeners had a wonderful Christmas season. And even though it's late in the day and it has been a slow news week, understandably, we are still coming to you as there's always something to comment on. And we also wanted to get in our last thoughts for the year 2025 before we launch our outlook next week. So without further ado, let me bring up the slides. I'd call this podcast a season of plenty / a year of enough. As we are in a season where excesses are legendary, I thought it would be appropriate to ask whether consumers and indeed investors are getting to the point of saying enough of certain excesses in terms of excessive prices, as well as asking whether some of the advances when it comes to technology are equally enough. As usual, we will cycle through 5 topics: inflation, interest rates, equity markets, geopolitics, and other asset classes. And in terms of some of the subtopics today, we ask whether growth exceeding expectations is all that it seems. We'll also look at the politics of enough and look at how the siren call of affordability is circulating through global markets and global investor and voter bases. We will look at some of the phenomena, should I say, of 2025 in terms of the tokenization of everything and the fact that everything is now a subscription. And we'll ask whether that is perhaps reaching its peak. We will dig into some of the data that we're hearing both around data centers as well as data itself and ask whether that too could be reaching a peak. And finally, we'll look at some portfolio implications as we near the end of the year. When it comes to inflation, there have been 2 real trends evident in inflation. We know that inflation has been falling, and in the US has fallen quite notably to 2.7%, and they're reflecting slower housing and food, which has been a very welcome reversal of that trend. The other trend has been the surge in electricity pricing, which we've spoken about before, but that is the trend that has been driving some concern around the opening of data centers and equally has been driven by increase in energy pricing. We've seen that energy prices have soared 4.2% over the last 12 months, with the food category rising 2.6%. So a welcome slowdown in food price inflation. Turning to the vibe check, we can see that the consumer confidence, the index, if that is split by income, the higher the income, the higher the confidence. That should be no particular surprise, as we've known that this K-shaped recovery has hurt far more at the lower end of the income spectrum. But if we look, it's interesting at the mid-range of the income from 50K to 75K, that the confidence there is matching the low level at the 35 to 50K, which would be the lowest level. So neither the lowest earners nor the mid to low earners are particularly satisfied where we stand today. But equally, even those higher earners earning 125K or more are still seeing a tick down in their confidence level. As we've shown before, when we split this chart by stock ownership, the top tercile of stock holdings have generally had a higher consumer sentiment than those that hold no stock holdings. So your consumer sentiment will generally be dictated by how much you are participating in this market rally, which was, as we've seen, has continued to hit new highs and set new records. When it comes to the economic growth itself, the story of resilience of 2025 has continued right to the end of the year. We have seen a bumper US GDP number in excess of 4% for the last quarter. That's year on year. And that has been defying expectations and essentially has been the reactions have been one of jubilation that the US economy is so phenomenally strong. There have been quick to point out, though, that there have been some commentators have suggested that this 4.6% was a quarter-on-quarter number, an annual number quarter relating to the third quarter of last year, so that is a deceptively high number, that actually, if we look at year on year, the annual rate is closer to 2%. So as always, there will be much digging in the data, but so far it does seem that these numbers are particularly strong, although we do have to factor in that imports were significantly slower in the third quarter and the exports were higher. And that number perhaps is still a carryover from the tariffs and the fact that there was inventory building in the beginning part of the year, and we're seeing slower imports this year as a result. Speaking again about the K-shaped recovery, we are seeing again this split between the dollars held in corporate equities and mutual fund shares per household. When we look at the top 20% versus every other quintile, it's notable just the sheer volume of stocks that is held in the top 20%. When we translate that further into the top 10% of US earners and how much they represent when it comes to spending, we can see the chart on the bottom right that the top 10% of US earners account for nearly half of all consumer spending. And this is a divide that is only increasing, as we can see the way the red line and the blue line are diverging. This is extremely significant, as what it does suggest is that the stock market will continue independently of how the consumer at the lower end of that K is reacting. So that consumer that is not among the top 10% and is in fact closer to the bottom 10%, as that consumer continues to struggle, that will not be moving the needle when it comes to consumer spending, which is going to be interesting to see how that consumer segment is treated. If that consumer segment is not moving the needle when it comes to spending and is therefore not necessarily being reflected in difficult corporate fortunes, where will we see that lower end consumer and its struggles be reflected? I think we've already seen that in the case of the dollar stores and some of the lower end restaurant chains, that is where the lower end consumer spending does have a disproportionate effect, or perhaps a proportionate effect, bearing in mind that how much they would use of those services. It also suggests that if the stock market is not reacting to the plight of the consumer at the bottom left side of the K, what will be reacting to that plight? Will it be politicians? We've already heard about the siren call of affordability that is circulating through global markets. If it is not politicians, will it be eventually policymakers that start to pay attention to this end of the consumer? We will see this ongoing divergence, therefore, between Main Street and Wall Street, as this consumer doesn't move the needle when it comes to the numbers, but it will, I believe, be an increasingly large drumbeat as 2026 rolls on. When it comes to the rally in equities, it has been Santa Claus rallies all around, and we've seen the S&P 500 hitting a record on the fourth straight up day. This is just in advance of Christmas. We saw the technology shares were continuing to lead the way, with Broadcom and Nvidia rising. And if we look to the chart on the bottom left in terms of which stock markets were participating in the Santa Claus rally, it was across the board, the Dow Industrials lagging, but nonetheless all showing a very similar trend. The S&P and the NASDAQ all rising over the course of the week, hitting a record on a fourth straight up day. So a nice trend into year end there. Some other interesting trends seeing in markets was that cyclicals have been pulling ahead of the broader market. This has been a phenomenon going back about 2 months to the beginning of November. We can see that the top yellow line there has been doing particularly well. And a trend that we've been noting for some time over the course of the year, but now is actually quite explicit when we have the year-to-date numbers, is how Asia has surpassed the US and Europe in a strong year of stock gains. So even though the talk has been mostly about US exceptionalism and its persistence, despite the fact that it did get knocked in confidence around Liberation Day, we can see that overall, while the trends have been similar, the US has surpassed Europe in terms of gains year to date, but that Asia is well ahead of both. We have seen some outsized returns in certain Asian markets, namely China, Taiwan. Much of that has been related to their technology exposure, but this is a very notable recovery in stock markets, one of which may have been considered uninvestable just 18 months ago. So this will no doubt, combined with the weakness of the dollar, which we will discuss later, be another strong vote in the column in favor of global diversification when it comes to equity holdings. How are investors voting with their feet when it comes to their investment in equity markets? We can see that there has been a windfall in terms of flows into ETFs, as well as a trading volume increasing there, and that just the ETFs themselves responding, the issuers of ETFs responding to strong demand when it comes to launches. We've seen over 1,000 ETFs launched in the course of 2025 year to date. That's through December 19th, so not even the entire year. And that is about 20-30% higher than the number launched in 24 and significantly higher than the last 4 years before that. So the other factors have all been higher in terms of flows, 1.5 trillion, close to that into ETFs. over the course of the year, all positive flows over the last 6 years, but increasing steadily. And then the total trading volume in ETFs now at an all-time high of $60 trillion. This is quite a strong indicator of not only FOMO at work, fear of missing out, as notwithstanding the fact that interest rates have been relatively high, investors have continued to chase returns within equities. And equally, most ETFs do tend to be passive exposure. They tend to have lower fees. We can see a preference here at work when it comes to investors seeking passive exposure as well as lower fees. And even though there are active ETFs, they would be a minority of ETFs. So a strong trend towards equities as investors seek return, seek to overcome inflation, and ultimately not miss out on some of the record returns that we've seen in equity markets. What else has been the theme of 2025? We've seen it as a defining year for metals. And if we look at the chart on the top left, silver and gold, silver most notably, mainly because of the role that silver plays as a component metal in many of the manufacturing metals needed for the current technology wave. We can see that silver has done particularly well over the course of the year, even though it lagged gold until about mid-year. And gold had itself set an all-time high in 50 days of 2025 so far, and it's having its best performance since 1979. So clearly those gold bulls have been vindicated over the course of the year. And there are many indications that this is a trend that is likely to continue. Why is that? We've spoken before about the concern around currency debasement. And as we'll show in the next chart, we have seen a particularly challenging year for the US dollar. But also when it comes to the lack of trust in governments and their ability to maintain fiscal propriety and not incur a large fiscal budget deficit and not kick the can down the road for future generations, there is a growing concern that that is not going to be delivered upon. And if we look at trust in government, and these are all analytics that we should look at carefully over the course of 2026, whether the fact that we have had somewhat relative instability in governments, particularly in Europe, relative to their history, and we've had also quite a bit of populism in the electoral outcomes across Western democracies, will that be a sign that the trust in government is low? And if the trust in government is low, is the trust in government institutions low? And this may well have been why there was such concern about the threat around the central bank independence in the US in particular. So if we are not trusting institutions to the same degree, does that suggest that there will be an ongoing demand for gold as one of the most reliable and long-standing hedges against traditional assets? Looking across the rest of the economy, I think it's important to pick up where we are in terms of both M&A transactions as well as consumer health. Take the bottom headline first. We are seeing a discussion around the price of cars. That typical new car in the US has now broken a $50,000 barrier, with car payments now averaging more than $750 a month. This is at a level that would tend to rival at least a significant portion of rent or mortgage payments for consumers. So cars, that to me is an indication that we are going to see defaults. $750 a month on car, it simply wouldn't be, and on a depreciating asset would not seem to be a sustainable number, with 100-month car loans now increasingly the norm. If we have car loans being extended over the course of 8 years, what will that say about the ability to both maintain these relatively high payments, as well as whether this will simply be sustainable in terms of pricing? So I think a very strong indicator that the consumer is under strain with those figures. Also, another headline regarding the takeover of Janus Henderson, $7.4 billion. This has been a continuing trend of take privates of, we can see the asset management industry has been taken private. There's still a strong belief in certain segments of the asset management industry, not every segment, not every equity, for example, not every active equity manager is seen as having a sustainable business, but equally there is a strong indication that asset management itself has gems of essentially diamonds in the rough that are still very interesting candidates. So I'd say a very interesting trend when it comes to manufacturing M&A. We're also seeing a suggestion that subscription overload is exhausting Americans. And we've had a lot of coverage of the battle for Warner Brothers between Paramount and Netflix, and suggestion that this, if price competition for subscription and initial price cuts go away, that this will simply become an unsustainable business model for streaming. Most Americans are weary with having multiple subscriptions. We know there is an interest in certainly reducing the number of tokenization and the number of subscriptions that they have. So this is another indication of the consumer under some pressure. Looking again back to data and the data center, we're seeing that there are increased probing of the financing behind data center debt. We've already had some coverage of Blue Owl and its refusal to stump up more equity for a data center that was perhaps seeing more strain. And we do know that the tech groups have been shifting these data centers, the data center debt, off their balance sheet and using creative financing to so-called insulate big tech while binding Wall Street to a future boom or bust. This is something to flag notably for 2026. We've already discussed the potential for data center build out to reach a headwind of consumer demand and interest in supporting these data centers in certain communities. And if we now have the perception that there's a lot of private credit issuers have been tied up with data centers, whether that will be an indication of perhaps contamination from data center trouble into the private debt segment, that's another thing we will need to watch. Finally, a talk on the dollar. We've seen that the dollar is poised for its biggest annual drop since 2017. We look across since 2015 at the Bloomberg Dollar Spot Index, the dollar is down close to 10% this year. This has, by some measure, been by design in that the Trump administration had wanted to have the dollar reduced. We can also suggest that this has been an indication of a lack of interest, perhaps, in a pure US play when it comes to equity markets and to assets. We've seen some aversion to US assets, according to European and Asian investors who decided to seek their diversification elsewhere. We've also, as we've shown earlier, shown the outperformance of Asian equity markets year to date, suggesting that investors have seen opportunities elsewhere and are seeking diversification outside the dollar. So this is one to flag. We have looked at the results of strategists and their output for 2026 outlook, and there has been a general sense the dollar could remain under pressure, particularly as the Fed seems committed to reducing rates, as we've seen. So a lot to watch for in these early months of 2026. And that has been our short Christmas update on markets and where we sit for 2025. So thank you, everyone, for following us over the course of this year. And we look forward to seeing you with lots more content in 2026. Happy New Year, everyone.